Housing starts falling sharply in January, down nearly 15% from December, marking the biggest drop since April of 2020. Joining us now, Apollo Global Management Chief Economist Torsten Slok. Torsten, it's great to have you back on the show. I'm going to start with a big, broad question for you, and that is the path back to 2% inflation challenging, absent more loosening in both the labor and housing markets?
That's a really, really important question, Morgan, because the issue is exactly with the housing market that the problem we have is that there are simply not enough homes for sale. In other words, the number of homes that are listed that's available for people to buy is still very, very low. And why is that low? Because remember, out of all homes that are sold, 7 of homes sold, 6 are existing homes, 1 is a new home. And for all existing homes, namely 6 out of those 7, people are basically sitting and leaning back and saying, I'm not offering my house on the market because I'm not leaving my 3%, 4% mortgage to go into a 7+ mortgage. So the problem is the upward pressure on inflation is coming back from the housing market. We have the Case-Shiller index is beginning to go up now 5% year over year. And given housing has a weight of 40% in the CPI basket, the short answer to your question is that in particular from the housing market, we're at risk of seeing renewed upward pressure on inflation. And also to your other point about the labor market, likewise, wage inflation still remains relatively strong. So that also continues to be an upside risk to inflation.
Okay. So I know you've been on this show and you've been on CNBC in the past, and you've talked about the possibility of a no landing scenario here for the economy. When you look at the data we got this week, whether it is CPI and PPI or even some of the other reads that we've gotten, including claims which continue to be stubbornly low here, is this January effect playing out in the data, or is this early evidence perhaps that we are in a no landing scenario?
I think you are right. This is early evidence. And why is it early evidence? Because remember, the Fed pivoted at the December FOMC meeting on the 13th of December. They basically began to say green light for issuing more IG. And that's exactly what you saw. Record high issuance of IG in January. The multi-year high issuance of high yield. Also loans coming back. You also saw M&A activity coming back. You also saw IPO activity coming back. With that backdrop, it's not really surprising that the employment report was strong in January. And likewise, therefore, it's not really surprising that also the CPI and PPI reports, in particular coming from services, have also started to pick up. So I think it's much more fundamental that the Fed essentially changing their tone as they did at the meeting in December. That's the reason why the data is now showing more signs of improvement. So that's why I do think that we will see more hawkishness from the Fed, so that they have to begin to talk more in the direction of saying, well, there is a risk that we might actually have rates higher for a lot longer than what the market currently is expecting.
So, Torsten, back to your first point, what do you think happens when the job market eventually weakens significantly if rates haven't come way down by then?
Yeah, that's a really important question, because at the moment, think about it, we're having problems in the banking sector in a strong economy. We also have problems with delinquency rates going up on credit cards and auto loans for some groups of consumers. We also have problems in credit that highly levered companies are seeing default rates going up, both in loans and also in high yield as a result of the Fed having high rates. And all these things and all these signs of weakness are seen in a strong economy. So to your point, John, if we begin to see that the labor market finally begins to soften, as the Fed now has been trying to achieve literally for 18 months, that will end up ultimately exactly creating a lot more problems, because we already have segments of consumers, segments of firms, namely those that have too much debt and have too low savings and too low cash flows, that they are the ones who will be most vulnerable.